Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger Associates Financial Planning. I'm pleased to be joined today by Nick DeVito, also a certified financial planner with our firm. Nick, thanks for joining us.
Yep. Thanks for having me.
So we're about to go through the third part in a three-part series on tax planning. We spent the first part kind of talking about the history of the taxes and the code. Spent almost the entire second part just talking about how the taxes work. Again, we're only talking about Fed because state and local, they're fixed. The Fed is anywhere from 0 to 37%, and how can you manipulate the taxes, and that's what we want to talk about. So we left off, the entire part two was talking about the different tax brackets, I'm sorry, not the different tax brackets, but more so how the taxes work. Okay, so what I'm going to do is I'm going to go back to that just sort of as a refresher and take a look at this particular slide. So as we talked about the last time, we are currently in the lowest income tax bracket structure. These are the 2024 tax rates. So what happens here, and we talk about on the left-hand side, is this is basically your tax return. And this over here is how they calculate your taxes. And we did this to simplify it, to show basically your 1040, that's how easy it is. And then on the right-hand side, if you're an old guy like me and you did your taxes years and years ago, you're rifling through the book and you follow it down. It's like, oh, that's my tax. Now you scramble through your W-2s to see whether you're getting money back or well, if you've ever wondered how in the world they came up with that number, that's how we showed you in the prior episode. So check out part two. If you missed part two, you got to check that out. But we kept alluding to is people are likely going to be in a higher income tax bracket in retirement than they are today. And why is that? I will tell you why, because I'm going to give you, and I'm going to shoot it down on just a few reasons why we believe people are going to be in a higher income tax bracket in retirement. One is the phantom taxation of Social Security. Another potential reason, how do I get that to stop? Is the higher tax brackets. Third is IRMAA, which is income-related monthly adjustment amount. That's basically the excess that you pay for Medicare premiums. And lastly, the potential of a surviving spouse. And where a lot of these things come into play is why we believe in many regards people run the risk of being in a higher income tax bracket in retirement. Typically, it's a combination of all of these, but honestly, it's mainly because of number one and number two. Okay, because obviously people in retirement, they're collecting Social Security, and the question is Social Security taxable? And the answer is?
It depends.
It depends, and it depends on what?
All your other income.
It depends on your other income.
Yep.
So let's talk about how Social Security is taxed. Nick, you want to take this?
So essentially what they're doing when they're determining if and how much of your Social Security is taxable is they're going to take a look at all your other income. So that could be earned income, that could be IRA distributions, rental property income, any other income you could think about. And they add that to 1/2 of your Social Security, and they do what's called your provisional income. Now, you're not going to see this anywhere listed on your tax return. It's more of a background calculation. So essentially they take that. Once again, that's all your other income plus 1/2 of your Social Security. That gets you your provisional income. Then they come over to this table you see on the screen. And they're going to say that you see on the left side, that's single. And then the right side is married. So for a married couple, the first $32,000 of that provisional income means none of it's taxed. It's taxed 0%. The next $12,000, 50% of that is taxable. So it's $12,000 delta, meaning $6,000 is taxable. Anything above and beyond that is taxed at 85%. Now, it is important to note the maximum amount of your Social Security that is taxable is 85%. So there is
Right.
there is a cap to it.
Correct.
Now on the single side of things, same principle, just different numbers. 0% up to 25,000, and then 50% from 25 to 34,000. Same principles apply.
Right, and anything over that is at 85%.
Yeah.
And to his point is, let's say married, it doesn't matter. Let's say the household Social Security income is $60,000. All right, how do I get this to stop? So if it's $60,000, the max is 85% of that, which means the maximum 85% of $60,000 is actually $51,000. So if you went through these calculations and you found that the calculation for the taxable amount of Social Security is $75,000, it's capped at 51.
Yep.
That's an important note. But the key really comes into the marginal tax bracket again, which is what I've never met anybody who really understands this.
Yeah.
But we preach it so much and all the time. So let's talk about that. Let's do an example of one.
Yeah. So let's just say, for example, you have your gross Social Security between we're talking about a married couple here, is $40,000, and then you have all other income, IRA distributions. Let's call it for $34,000. That means, and once again, you're going to take 1/2 of Social Security. So you're going to take 1/2 Social Security, which is the $20,000 plus the $34,000, get you to $54,000 of provisional income. So then you come over to those brackets on the left, and you see that you're in that 85% range. So once again, 0 to 32,000, 0%. The next 12,000 is 50%, so that's $6,000. And then you have $54,000, and that's $10,000 above $44,000. So that's $10,000. Now 85% of $10,000 is $8,500. So you add the $8,500 and the $6,000 together, you're looking at $14,500, and that is how much of your Social Security is taxable.
Right.
So basically $14,500 of your $40,000
Right.
in Social Security.
And again, the cap, the max is 85% of 40,000 is 15% is what, 6? Your cap is 34,000. Right? So that's the most. So therefore, they're paying tax on 14,500 of their 40,000, or of the maximum is 34. So this is what happens now. So now we go back to the tax return, okay? And let's say this is in 2026. So what happens is that they had $34,000 of other income. Right, is that what it was?
Yep.
34?
34.
34,000 of other income.
40 in gross Social Security.
Right, and then we had $40,000 in gross Social Security, but only $14,500 is taxable. So what happens is now they have an AGI of $48,500. Then they subtract out their standard deduction. Let's say it's $29,000. Oh, this is a horrible example. And then basically what happens is that they have a taxable income of $19,500. And in this particular instance, they go, and here they are, they're in the 10% tax bracket. Okay?
Yep.
I would like to use a different example to illustrate a point that I am looking to make. Actually, no, we can use this one. I am going to go ahead and keep an eye on this. So one could argue, when we talked about the tax bracket, they're in a 10% marginal tax bracket, right?
Once
Okay,
again,
great.
when we're talking about marginal tax bracket, we're looking at if you took another $1,000 of income, what would your tax be?
Right, 10%, $1,000.
You would think.
Right, you would think. It's not, okay? So if we took another $1,000, as we talked about before, that $1,000 is going to noodle its way all the way through the tax return. It goes up by $1,000, and now $19,500 becomes $20,500, and that 1,000 gets taxed at 10%. Right?
Wrong.
Not so fast. Okay, so here's what actually happens. So I'm going to go back to this calculation. And so what actually happens here, is that the one? Yeah, that was the one.
Yep.
So let's say, for instance, in this particular case, let's say we pick up an extra $1,000. we take an extra 1,000 out of the IRA. Okay? That means, correct me if I'm wrong, 34 becomes 35,000, which means plus 1,000. This becomes 55,000, which means we pick up an extra $850 in Social Security, right?
Yep.
What does that really mean? What that means is that their $1,000 of income picks up $850 of Social Security, which means their taxable income just went up by $1,850. So now we go back to the tax brackets, and instead of it going from 19,500 up by 1,000, it went up by 1,850. So their tax bracket is 1,850 times 10%.
Yep.
So they just paid $185 in taxes. So let me explain how this works then. Is therefore, in this particular case, they took an extra $1,000 of income, which resulted in an extra $850 of Social Security, is $1,850 additional taxable income. Multiplied by the 10% tax bracket, they just paid $185 on $1,000 in taxes. That's 18.5%. But wait a minute, I thought they were in the 10% bracket. Right.
Yeah.
Exactly.
You would think, once again, it's a very common misconception, and
Right.
not even a misconception. People just don't necessarily
know.
understand how the taxation of Social Security works.
Now, what's going to happen is the example that we used, most people are probably going to have, especially married, are going to have more than $40,000 in a household for income.
Yep.
Okay. And if all of a sudden you're taking money from your IRAs, most people are actually going to land in the 15% tax bracket. So you take a look at that and say, well, gee, what if I take my $1,850 and multiply it by 15%? If they're in the 15% tax bracket, guess what? They're paying $277.50 on that $1,000. That's 27.75% tax. Oh, by the way, if they're in the 25% bracket, that is $462.50. They're paying 46.25% tax on that $1,000. Oh, by the way, you take a look at the history of the tax brackets. What were they always? 15 and 28. We don't know that the tax brackets are actually going to revert back. That's what the current law says. But what's to say that it doesn't actually revert back to what they were in 1986? Okay, after 86, that 15 went right from 15 to 28. And if they do that again, and we've demonstrated we need to raise taxes to balance the budget.
Yep.
If you do it 28%, you're paying $516 tax on that $1,000. You're paying 51.6% tax on that $1,000. How's that 22 or 24 looking good today?
Sounds pretty good to me.
It sounds awfully good. So are you going to be plowing money into your 401k and getting a 22% tax bracket to only pay
No.
27.75,
That doesn't make
46 and a quarter, 51? Yeah, no kidding.
Once again, when you're deciding between traditional and Roth, am I going to be in a higher tax bracket now or later?
That's correct. And so what you really need to be doing is you need to be projecting out, what are my tax brackets going to be later? Well, tax brackets are tough to project, but you can reasonably project your income. Okay, how? Well, you got your Social Security statements. Your Social Security statements say how much you can earn at age 62 all the way up to age 70. So on average, most people are somewhere between $2,000 at age 60 and $4,000 at age 70.
Yep.
Let's say the average is $3,000 in the middle times two people. That's $72,000 worth of Social Security that a household could be earning. Okay, obviously it could be less if one was taking it earlier, if their income was lower, whatever the case may be. Okay, so that made our numbers look a little bit on the low side. Okay, but the reality of it is that, you know, especially people my age have been ingrained in our system to be contributing to the 401k, pound it, because logic would have it that By the time you retire, you're obviously making, I'm making $300,000 today. I'm making zero in retirement. So meanwhile, I'm sitting here plowing away at my 401k. I'm building my 401k up so that in retirement, I'm going to drag money from my 401k. Or move it to an IRA, same difference. When I start taking money out of that, that money is going to be taxable at the higher rates and causing my Social Security to become taxable.
Absolutely.
All right, so what we're going to do is we're going to conclude the first segment of this particular episode on part 3. We're going to conclude right here. We're going to pick up and talk a little bit more about strategies that you can employ. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, and I'm joined here with Nick DeVito, another certified financial planner on my staff. We spent last segment of the third part of 3 episodes. Okay. Spent the second episode talking about how income is taxed and how the tax bracket system works. Spent the first segment of this particular episode talking about the taxation of Social Security. What I'd like to do is then finish up with talking about the time horizons of most people's lifetimes, the IRMAA, which is the Medicare premiums, and some simple strategies that you can employ for tax planning. All right, so let's go. So for starters, what I'd like to do is just talk about timelines, okay? Generally speaking, I like to say people are going to live and their money is taxed on 4 time horizons. Now I say their money, I really mean their IRAs and their 401ks.
Yes.
Because fact of the matter is that you got tax deductions on that money when you put it in. It's gonna get taxed. It's a question of when and how much. So most people are living on these 4 time horizons, okay? How do I get this to stop? Okay. First time horizon is in 24 to 25. That is when we're in the low brackets. And by the way, what I'm referencing here is a married couple, okay? Then the next time horizon is when they're in the higher brackets. In other words, starting in 2026. And arguably, you can even say, once you begin collecting Social Security, okay? Because now that's that whole phantom taxation of Social Security comes into play. But then the next time horizon is when you have a surviving spouse. Well, what does that mean? One spouse dies. Well, typically what happens when one spouse dies, the only income that goes away is the lower of the 2 Social Securities. Now, if the person who died had a pension, then that pension oftentimes is reduced. It depends on what method they took when they elected to take their thing, when they took the pension. But what happens now is they move from the married side to the single side.
So it essentially gets cut in half.
Right. They hit the same brackets at half the income.
Exactly.
Okay? So then what people fail to consider is what happens to the beneficiaries. And we're beginning to see this crop up a lot because a lot of people had pensions, but were given the ability to take a lump sum distribution of their pension. Or a lot of people have been contributing the daylights out of their 401ks. The next thing you know, they're amassing a large 401k. Well, if one person dies, then the other person has to take the same RMD out, which is roughly 4%, 5% of the total assets. Now they're on the single side taking the same income. What happens when that person dies? Now, under the new Secure 2.0, which came out in 2020, the beneficiaries must take that money out within 10 years.
And just to clarify what an RMD is for those who don't know, it's a required minimum distribution. And essentially that's just the amount you have to take out of your traditional IRAs or traditional 401ks once you reach age 73.
Which goes to 75 at some point.
Yeah, it changed to 75, but right now, once you turn age 73, you're required to take distributions from your IRAs and 401ks.
Right, but then they have a different RMD that applies to the beneficiaries. I'm not going to go deep into those rules, but in either case, what happens is that the beneficiary must take the money out within 10 years. And if you were to use a basic calculation, it's about 14% has to come out per year, meaning that if you had $100,000, you'd have to take $14,000 out per year for 10 years. Well, why? That's up to $140,000 because you got to factor in growth.
Yep.
Okay, assuming it earns like 5 or 6%,
Yep.
you have to take 14% out per year. Well, that's fine. 14,000 is not going to kill anybody from a tax perspective. But what if it's $1 million IRA or a $2 million IRA, and you got one child?
Mm-hmm. And most of the time, you're passing away when your children are in their prime earning years.
Correct.
So you're stacking their RMDs on top of their already likely highest income they're going to see in their life.
Right.
And you run into a tax issue.
Right, and they're like, I don't want to take any more out than I have to.
Yeah.
And, it ends up being a runaway train, and we're starting to see a lot of that.
Yep.
People are amassing large IRAs. They're like, well, I don't want to take more than the 4% I have to take out because that 4% is a lot of money. If they earn 10%, that IRA is growing by 6%.
Yep.
And if it keeps doing that, and guess what? You got yourself a runaway train.
Yep.
And that can be problematic. So all these times are when these are different time horizons, but you got to look at what the tax brackets are at each of these different time horizons. And I will tell you, in most cases, the lowest tax brackets are right now. Now, let's talk about another thing. Is they have this thing called IRMAA. Again, it's the Medicare premiums go up, and I'll let you take this one.
So essentially, they take a look at your MAGI, your modified adjusted gross income. So that's your adjusted gross income, except they're adding in the full amount of your Social Security, and then any tax-free interest comes back into the equation.
Right, any income that you received that wasn't taxed.
Yes.
So basically munis and...
Yeah. So they're taking a look at your MAGI, and they have brackets for this. And they're saying, okay, if you're within this threshold, you're getting an additional charge for your Medicare.
Right, it's a premium increase.
Premium. And now what's important to note about these brackets is they're not like the federal income tax brackets where if you go over by a little bit, only the part that you went over is taxable. With Medicare brackets, when you jump into that next bracket, it doesn't matter if you went over by $1 or $10,000.
Right.
You're in the next bracket.
Right.
So if you look at the table here, we have the single versus married, and you can kind of see the Part B adjustment based on your MAGI. And you should kind of go down the list and look at what that means for you. So it's another thing you have to keep in mind is if you're taking more out of your IRA, your MAGI premiums might go up. And
That's correct.
you can call that what you want, but in exchange of money based on your income between you and the government is a tax.
That's right.
So it's another thing to keep in mind when you're looking at your tax bracket and your marginal tax.
That's right. And so these are the things that these runaway IRAs can do.
Yep.
Okay? And you're taking your RMD, 4%, but if suddenly you're on the single side, okay, your RMDs combined with your Social Security and other ancillary income are probably putting you in elevated, having to pay extra premiums for Medicare. That is often not considered, but you got to take that into consideration because, like you said, any exchange of money between you and the government that's associated with your income, that's a stinking tax.
Yep.
Okay, so take that into consideration. Now, what's the sister program to Medicare?
Social Security.
Social Security. I'm going to go on record as saying this is a conspiracy theory. So I'm not saying that this is the case. However, the question becomes, Social Security is supposed to run out of money in 2033 or 2034, which means that there's not enough money going into the system to pay all of the people that's coming out of the system, and it runs out. So the question is, what are they going to do at that time? So if it's 20% short, are they just going to cut everybody's Social Security check by 20%? Are they going to raise everybody's tax on Social Security by 20% to make it up? Or could they possibly means test Social Security? Like, for instance, Does Bill Gates need Social Security? Probably not. Okay, so you take some of the uber wealthy people, do they really need to be receiving their Social Security to live? Well, is it fair? No, of course not. I never said it was fair.
Yeah.
However, if there's not enough to go around, it's a whole lot easier to pass a law that says the people making above a certain threshold. What is that threshold?
Exactly.
Okay?
You don't know.
Don't know. But if they do that, and all of a sudden now they're cutting your Social Security, once again, there's another potential tax there. Now, it's a conspiracy theory, right, wrong, or indifferent. I don't think they will, but they could.
It's possible.
It's possible, and you always have to take these things into consideration. So, Mike, you're doing nothing but giving bad news. All right?
What can we do about it?
What do we do
What can
about
you
it?
do about it?
Okay, so let's talk about this. These are some common strategies that we talked. I'll let you start it off.
Yeah, I mean, we talked about the Roth versus traditional once again. Higher tax bracket now or later. If you're in a higher tax bracket now, okay, then you can take the deduction. If you're in a lower tax bracket now, don't take the deduction. Go Roth, and you're setting yourself up better for the future. And then we have another thing called step up in basis. So step up in basis, essentially, let's go back to the stock example we'd used in one of the earlier episodes. Say you buy $10,000 in stock, it grows to $15,000. If I were to pass away with that stock and leave it to my beneficiary would inherit it as if they paid $15,000 for it. So
The value
step up
of
in
that.
basis is the gain essentially is
washed out.
washed away. So it's just another kind of tax planning thing you can think of. You're getting older. Maybe don't sell the investments that are highly appreciated because you get that step up in basis. We also talked a little bit earlier about Roth IRA conversions. And once again, going back to the buckets, there's 3 ways in which you can get money into that Roth bucket. You can contribute to it, you can do conversions, and in both if you're contributing to it through your either Roth IRA or Roth 401k, you need to be working.
Right.
401k is through the employer, and to contribute to a Roth IRA, you need to have earned income. So the only way to get money in that bucket without earned income is through Roth conversions. Once again, you're moving money from the IRA to the Roth. You're paying the tax on whatever you convert now, but you have tax-free growth.
Yeah, here are the buckets.
Yep.
Okay, I'm showing the buckets
Back to the
again.
buckets.
So yeah, and that's basically the case. So the Roth conversion, to your point, is taking money from the IRA and moving it to the Roth, and you pay the tax now at today's rate. I always like to say, the IRA is 3 letters. It's pre-tax, which is 3 letters. 3 letters. Bad. Okay. Then you got the Roth, 4 letters. It's post-tax, 4 letters. Oh, good. Okay. But once again, it all comes down to planning as to evaluating what your tax brackets are today versus where you anticipate your tax brackets are going to be later. As I pointed out, a lot of people who are decent amount of income, particularly younger folks who are probably going to find themselves in extraordinarily higher income tax brackets just between now and the time that they're working, may want to take advantage of doing massive Roth IRA conversions, because if they can reasonably predict that they're not going to be in anything under 25%,
Yeah.
then you really want to do it. Now, I'm going to go back to that 15 and 25% tax bracket for one moment, because what I want to point out with that is looking at these tax brackets, I'm going to clean up my mess here, is we take a look at these tax brackets and people are going to well, gee, Mike, I'm going to hit here with my Social Security and everything else. Well, the problem is, and we talked about this, every extra $1,000 is causing Social Security to become taxable, which means this 15 is really 27.75%. And it doesn't matter whether you're on the married side or you're on the single side. Actually, it's the single side that I find people breaking through and hitting the 25% tax bracket and still haven't exhausted their Social Security. And they're paying 46.25% tax. So trust me when I tell you, this happens way more often than you think. But if you talk about that one couple, let's say they're $60,000, $70,000 worth of Social Security income, all of their income is going to be at 27.75 until they exhaust the taxation of their Social Security. And by the time they do that, they're up here anyway in the 25% tax bracket. So in other words, they'll never see 22 or 24% again, ever. And therefore, you want to take advantage of when the tax brackets are low like they are today.
Yep.
When it comes to maximizing, and I'm going to go back to that last statement where we were talking about maximizing the step up in basis, is between a married couple, you have the ability to transfer assets between husband and wife. And if one of the couple are potentially in failing health or older or whatever, you potentially could, and you want to talk to your accountant and attorney to confirm this, but you could potentially move money from the highly appreciated assets into the account of the person who is more likely to die. So if one spouse bought Microsoft stock 30 years ago for $10,000 and it's worth $100,000, it's worth more than that. If it was worth $1 million, if that is in the account of the person who dies, the inheritors inherit that $1 million with no capital gain. But if they were to sell it during their lifetime, they got $990,000 worth of capital gain. So you strategically manage that. Now, going back to the Roth IRA conversions, one of the things that we find the biggest struggle is paying the tax on it. Now, of course, if you're over 59 and a half and you wanted to convert $100,000 of your Roth IRA, your IRA to Roth, you always have the ability to take and reduce it and basically withhold.
Yep.
So if I wanted to send $24,000 to the government, very simple. Take $100,000 out, $76,000 goes to my Roth, $24,000 goes to the government. That's a wonderful thing if you don't have the cash.
Yeah.
But if you're under 59 and a half, you can't do it.
Unless you have a 401k. If you have a traditional 401k available to you and you separate from service
Right.
after age 55,
Which is a story in itself.
you can then use that. So it's just another way to
Right.
pay that tax if you don't necessarily have the cash flow for it. Generally speaking, you want to try to preserve the tax-free assets as much as possible. So if you have cash sitting somewhere, you
Right.
have an investment account, maybe consider using that to pay the tax to kind of preserve that tax-free asset.
Right, exactly. So the long and short of it is that what we're trying to do is we're trying to move money from the bad bucket over to the good bucket and pay the tax at the lower rate. Because the odds are, once these tax rates start going up again in a couple of years, you're probably, and if you're still working, you're probably going to shift back again to contributing to the tax deductible bucket. Yep. And so what I find is the odds are people are going to probably be in a 25 or 28% tax bracket in retirement. If you can pay less than 25 today, you try to take it.
Yep.
More than 28, you try to take the deduction. Of course, there is no pat answer. Every answer is?
It depends.
It depends. And therefore, we strongly recommend that you speak to your financial advisor or to your accountant to be able to ascertain and try to project what your taxable income might be in retirement. And with that, we're going to conclude the third part of the episode because we're probably running over time. So, once again, third part of the three-part tax planning, and I hope that everybody has learned something in each of these 3 episodes. And again, thank you very much for joining. And I'm Mike Menninger, Financial Planning Explained. Thank you again. I'll see you next episode.